Hi, this is Adam, AAA Adams, and you're listening to the Passive Investor Show.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to PassiveInvestorShow.com.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the Passive Investor Consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications and real estate funds. Our goal and purpose of this show is to be a resource to investors and help them master their passive investments by beating inflation 1% at a time. Today's guest, Adam, AAA Adams. Adam, also known in the real estate community as AAA, has educated thousands of investors through real estate conferences, radio, and podcast interviews, his coaching program, and his thriving meetup groups. Adam hosts a creative real estate podcast, a podcast listened to around the world with hundreds of thousands of downloads. His efforts to educate and inspire other investors has earned him the prestigious title Master Investor by Think Realty magazine, and he is also a 3-time Hall of Fame winner from RE Mentor for his successes in multifamily syndication. Meetup.com recognized him as one of the top 6 meetup organizers in the world. In 2005, Adam took the plunge into part-time real estate investing, but it quickly became his full-time passion. Today, Adam is partnered in 7 multifamily syndications with approximately 1,400 doors, valued slightly over $100 million. His company, BlueSpruce Holdings, focuses on finding and managing apartment communities to allow passive investors diversification, cash flow, tax benefits, and freedom of time. Adam's primary role in the company is to track capital, successfully raising millions of dollars from private investors. He continues to grow his company's brand as one of the top syndication teams in the United States. Welcome to the show, Adam. Glad to have you.
Awesome. I need to shorten my bio. I feel bad. That was a mouthful. I apologize. I'll try to cut it in half.
You earned those, right? Those are your stripes.
There you go.
Adam, tell us how you got here.
I got here, really, it goes back to my stepfather, long time ago, born on a polygamous colony in the middle of nowhere, true story. And the whole reason why my last name is Adams and my first name is Adam is because I got my mom's maiden name later on in life, true story. And then she married this guy named Jeff. Jeff is one of the coolest dads, and we just had Father's Day. Happy Father's Day to everybody. We just had Father's Day, and I sent him a message, Happy Father's Day, you changed my life. Such a great guy. Thank you so much. And he said, right back at you. But the thing is that he really changed my life because he's the one and the reason why I ever got into real estate. I collected rent when I was about 9 years old for the first time at one of our multifamilies. So we had a multifamily that was right next door, and he was going to be late. So he asked me to go and collect the rent. And so I did that when I was very young, only one time, but I still remember it. However, I was doing flips of some of our rentals when I was very young. I was an early teenager, and I was helping put up walls and run electric and do all this kind of stuff. So that's my start, why I even got involved. So 2005, I was actually still in college in 2005, and that was the first time I ever did a real estate transaction at all. Basically, my dad bought me a piece of land, and then he made me pay for it right after. That's the short version. He bought it for me, he gave it to me, and then his accountant said, you can't just give it to him. He's got to pay for it. And so as a college student, I was like, how am I going to pay for this? So I did somehow pay for it. And then about 2 years later, I always joke about this, I got a tax bill, never knew what that was going to be, like real estate taxes. And it was a piece of land. And I was like, Dad, what the heck? Like, what, do I have to pay this? He's like, are you Are you delusional? Of course you have to pay it. It's your taxes. And I was like, I never heard of that. And you didn't tell me that this was going to be a liability. But the cool thing was I sold it, made a huge return, 8,333% return after all expenses, 12,000% before expenses, and ended up making more money in 2007 than I had ever made from the time I was born, a long time before that. And so I said, I'm not going to go to school for music ed anymore. I'm just going to do this all my life. My dad's been trying to tell me I need to do this, so this is what I'm going to do. And so I became a real estate investor, I guess in 2005 technically, but in 2007 I started managing apartments. In 2008 I bought my first multifamily. That was my real start. That was like why I ever got into it. And it wasn't until 2016 that is that like 8 years later, or yeah, something like that, 8 years later, when I first started actually syndicating deals. So that's only been the last 4 years.
I really love that. I love the journey. So let's pick it up right there where you started working with passive investors. How did that look like in the beginning compared to how's it look like now?
My first ever passive investor was on my triplex a long, long time ago, 2008. Had good credit, randomly enough. I'm one of those few people. I had good credit and I was making money, and the bank still wouldn't lend me money because the handyman company that I had, when I could only have 1 year of tax history, and they needed 2 because this was at the end of 2008. And so they would not lend to me. It blew my mind because if I would have tried to buy 2 weeks before, all I would have had to do is have a pulse and I could have got any loan that I wanted. And now all of a sudden I had great credit and I was making money, but I still couldn't get a loan. So my first passive investor came from somebody that I was a handyman to. So I did work on 2 of his properties, and one of them was a full remodel. So as a handyman, the guy's name is Tom, and Tom knew me, and he knew that I wanted to become a famous real estate investor. He knew my history. He knew what I did with my family, and I knew that he had some cash. And so Tom actually, the first ever passive investor I ever had, 2008, Tom wrote a check, cash basically, to the title company for this triplex that I wanted to own. He paid for it, bought it cash. And then what he ended up doing was gave me a, promissory note to pay him back. So all of a sudden I had a mortgage and a promissory note. And that was my first passive investment because he essentially lent me $375,000 or $385,000, something like that. And so I owned this triplex. The truth is, and the bad part of the truth is, in 2008, Utah was just getting hit. And 2009, we really got hit. And it got even worse in 2010. My handyman business took a plunge. My renters took a plunge. All of a sudden, they couldn't pay. I wasn't making 20 grand a month anymore. I wasn't netting 20 grand a month anymore. I was netting 2 grand a month. It was really hard for me to keep it going. So I did lose that property in 2011. I signed it back over to Tom in 2011, sadly. But that is a really good experience, though, because what it's doing for me right now during COVID, there's a lot of other people that are very bullish and they think this is a V curve and they're totally fine with buying. Well, I remember getting hit in a crash and then seeing aftermath for a couple of years. So right now we've decided in BlueSpruce Holdings, we've actually decided not to buy for a little while. And it's specifically because I got hit hard in the last crash. If I even have a slight suspicion that it might happen again, the wrong thing to do is to buy again. So I guess what I'm saying is my first ever passive investing taught me a ton, taught me more than any other deal that I've ever done.
So how's it compared to how you're managing investors now?
Oh my gosh. Back then it was one investor for one deal. That was one of the big differences. The next thing is that back then I didn't know all of the Securities and Exchange Commission laws. Luckily, I'm not an attorney myself, but I don't think that I broke the law talking to somebody that I had a relationship with. But what a lot of people are doing now today, they are just going out and talking to people at meetup groups and saying, hey, do you want to just lend? And that is actually a securities violation. So back then I didn't know about securities law. Now I'm hypersensitive to securities law. Back then I had one investor doing 375-ish thousand. I can't remember the purchase price. Might have been 365, 385, but around there. And then another difference is now we actually have our smallest deal has 7 investors, not one. And our biggest deal has over 50 investors. Back then I did it all by myself. I was the manager. I was the maintenance man. I was the everything. I collected rent. I mowed the lawn. I mean, I did every single thing on that property, and now I do almost nothing on that part of the property. I don't mow any lawns. I don't collect any rent like I did when I was about 9 years old or when I owned my first triplex. That's all different. I've got systems. I've got teams. We JV. We partner with people. I've got 13 people in my team. A few of them find deals. A few of them manage deals. A few of them raise equity. And so we're all one team, and we all live here in Denver, except for our virtual assistants that are in the Philippines that still do help us. The team's grown. The amount of investors has grown. The attention to the securities law has grown. What else has changed? The size of the deals, instead of 3, one of the deals that I've closed on with partners is 450 units, one deal. You know, the only reason why I'm over 100 million in total partnerships is because, you know, some of these things that I was able to close on are with really good people. Like Joe Fairless is a partner in that one 400 unit in DFW. But I'm just a very small piece of it, you know. So I've learned how essential it is to partner with other people. Man, there's so much. Yeah, I guess not wearing all the hats versus having a real actual business is the biggest takeaway.
So on this show, we talk about how passive investors are vetting sponsors, but the sponsors are vetting the passive investors as well. What criteria do you look for in passive investors?
I'm so glad you asked that, because a lot of people don't know that. So I didn't realize that was such a big part of the show, and I'm glad that it is, because that's something that a lot of people miss. That's what a lot of active investors, they miss. That they should be vetting their passive investors, and B, that they have the ability to not need the money, but realize that they're really offering an opportunity to passive investors, and so that they should be spending the time to vet. So just so glad that you even brought that up at all. But what do we do to vet our passive investors? There's a few things that we do. Number one, we close on deals in 2 different ways. Some of the deals we close are 506B, and some of them are 506C. And what that is, it's a regulation, D as in dog, and then there's 2 different main ones. The most common one is B as in your buddies. You're raising money from your buddies only. And then C as in the community. You're raising money to a whole bunch of people. You might not know all of them, but you can advertise and all this kind of stuff. So we raise money both ways. So if we're raising money from just accredited investors through 506C as in community, being able to advertise, all that kind of stuff. We can talk about it on our podcast. We can go to a meetup group. We can stand in front of a conference and tell everybody, or if we wanted, we've never done this before, but we could literally get an airplane to have pull one of those signs that says invest now, you know. But we've done some C's, as in being able to advertise to the community, even the ones that you don't know. And our vetting process goes like this. We ask you if you're accredited. You say yes. We say, okay, we'll show you the stuff. If you want to invest, then we must verify that you're accredited. And so we do that in a couple of ways. The easiest way on us is a third-party verification. So that is one way that we vet our people if we're doing a 506C. So we make them jump through some hoops to basically prove through a third-party person that they are what they say they are, because we're not allowed to let anyone invest if they're not accredited in those types of deals. For the 506B, it's a little bit different. It's a little bit different vetting process, and it takes a lot longer, and there's a lot more hoops to jump through. And the main thing that we want to work on, whether it's a B or a C, is if we even get along with them. Like, do we even like them? Like, seriously, there's some really frustrating people that you don't want to work with. I don't care what you're selling. You don't want this type of person as your customer. And that's the same with us, regardless if it's 506C or a B. We need to make sure that we get along with somebody. If we feel like we would enjoy dinner with them, we're gonna work with them all day. If like we could have a beer with them or have a glass of wine or go to dinner or go to breakfast with them or whatever, that is the beginning stage of we would even work with this person. But if they're overbearing, if they're trying to control the deal, like as a passive investor, your job is to provide money and be completely passive. But if you're trying to be like a project manager or another general partner, it's going to be too hard to work with you. It's not going to be like, you don't need to be a passive type of investor. You need to go and start your own deal because you need to have your thumbprint on everything. And that's not a negative thing to us. It's just, we don't want to work with you because you're the type of person who needs to control it. And we don't need a controlling passive investor. We need a passive investor. We do the controlling. That's us. That's who we are. And that's why I actually do both. I'm a passive investor and an active, but that's a major part is, can you have dinner with them? Okay. So let's get back into the B. What other things that we do? Number one, we make sure that the only way that they even could come into our funnel, and we'll probably talk a little bit more of this funnel because that's the way I visualize everything is this big old funnel. It's bigger at the top. It's smaller at the bottom. They need to know who you are. Then they need to like you. Then they need to trust you. Now they can do business with you. And they're moving into the funnel. With this funnel, you need to be really careful on how they even got into the funnel. If you told on a 506B, if you told somebody, I have a deal and it's at 123 Main Street and it's this kind of returns, if that's how they got into your funnel, you're breaking SEC law. So we make sure that we're not doing that. We make sure that if we're working with somebody and we're doing a 506B, that they passed a lot of hurdles. For instance, they've been to the website, they've seen that we do syndications, they've on their own decided that they'd like to be a passive investor, they've opted into our potential passive investor list, and they don't ever see deals until they've gone through the whole list and they've done a few things. The things that are important before they see a deal when we do a 506B is A, we need them to fill out an investor questionnaire. The investor questionnaire is going to explain to us if they have experience investing in different types of assets, whether it's real estate or something else. What is their experience in real estate? Have they been an agent? Have they been a flipper? Have they been a passive investor before? We need to get all of this questionnaire filled out. And that is something that gets date stamped and we know when it was filled out. The second major thing that we need to do is we need to actually have a conversation with them. So far, we've never shown them a deal. We've never told them that we have a deal available, and we're not even letting them. If I had a deal today, I wouldn't let this person yet be a part of the deal because they're still within the vetting process. So they fill out the questionnaire, then we have a call with them. On the call, we ask them things like, how much money do you have to invest? How much money do you make? How often does it come in? How long have you had that job? Do you know that the risks associated with investing in a deal like this? Do you know that it's not 100% guaranteed? I can't just say you're definitely going to get all of your money back because I don't know if COVID's going to happen or anything else like that, a pandemic. So we ask them questions like that. If and only if we feel like they are what's called sophisticated, will we let them invest in a 506B? Regardless if they're accredited or not, they must be what's called sophisticated. That just basically means they have to understand what they're getting into, that it's not guaranteed, even the preferred return, okay? A preferred return. I don't know why I lost the name of it for a second, but they get a preferred return. We want them to know that this is a preferred return. It only means that if we have enough money in the bank, we pay you this amount. And if we don't, we add this to your account that we'll pay you when we do. So basically saying you get paid before we get paid. It's not a guarantee that you get paid. So we just make sure that they know all of that stuff. if they pass all of this, then we will start saying, okay, we understand your financial situation. We understand your knowledge level. We feel comfortable with it, and we will let you invest in our deals.
I love that. And then they understand that it's a long-term investment and it's not liquid. I like that. Adam, now let's transition. What is something you had to implement in your business as a result of working with passive investors?
Yeah, one huge thing that I definitely had to implement, and I think it will be the same for a lot of other operators. And let me give you the reason why. The reason why is because we all have different personalities. Some of us are more analytical. Some of us are more like introspective. Some of us are more just optimistic, and we always think that we can achieve a lot of different things. Well, I have the natural personality of the typical entrepreneur. The typical entrepreneur always sees value everywhere, always sees the good in other people, always thinks that they can make money with any type of thing, and always thinks it'll be easier than it really is. And so that's just the natural personality. And I think that you're going to have a lot of listeners, if they're trying to be operators, that know themselves that they chase shiny objects too. They know because they were trying to do assisted living and fix and flip and multifamily all at the same time because they thought they were all good, and the more good is better, but it's actually detracting. So I had to learn that. But with people like that, if you resonate, if you know that you're one of the people that tried to do multifamily and self-storage and assisted living and fix and flips all at the same time, you know you're one of these types of people. And what we've learned about this type of entrepreneur, the main type of entrepreneur, the most common, is we're not afraid to fail. We're not afraid to jump into things. And we lack attention to detail. It's not that we can't do detail. It's that we don't want to. It's that we hate it. We despise it. We don't want to be involved in it. And what's interesting, you asked me, what did I have to change in my business because we're working with passive investors, is that I have noticed that a lot of our passive investors are engineers. Engineers freaking love the multifamily space. They have done all this research and they realize, because they have those engineering type of brains, that this is the right vehicle for them. This is the one that gives them the best returns with the least volatility of anything out there. And so we have a ton of engineers. What else do we know about engineers? They're very analytical. They spend a lot of time with the numbers, and they're the exact opposite person from me. If I'm speaking with an engineer, I want to just talk high-level things and then just get it over with. And they want the exact detail. So what did I have to change? The main thing is I had to hire a CEO for my company. His name's DJ. I had to hire a CEO who's very analytical, very numbers-oriented, and doesn't mind getting into the weeds of details like that. To me, it's the last thing I'd ever want to do. It just takes everything out of me to spend a lot of time on details. I want to think high level. I want to be excited and motivating and going to the next level and finding the next deal. And I'm a starter, not a finisher. I had to have a finisher on my team, or else I was going to lose credibility with my passive investors. I not only just losing credibility, I probably would have let major mistakes happen if I didn't have somebody like DJ on the team. So that's the biggest takeaway that I've gained by going through with all these passive investors, is that it's so essential that you have somebody on your team that is very, very, very detail oriented and can spend the time going through things with your passive investors, because your passive investors need it. They're going to have those questions. So that's probably the major thing that changed for us.
I love the humility that you just shared with that. I think that's so selfless of you, that you knew and recognized and made that shift quickly. I think that's awesome. Adam, what is one thing you do differently from other sponsors that benefit passive investors?
There's a lot, to be honest. And if and when we get on a call, Mr. or Mrs. Passive Investor, I'll share them all with you. But really one of the biggest ones is that my team, I have a bigger team. I would say a lot of newer sponsors, it's like one or two of them, or they're just doing JVs only. For us, we have everybody in our own house, right? We all meet at the same office every single week. We show up on Mondays. We have level 10s. We focus on having the business be a business, unlike when I first started 15 years ago, where I was wearing all the hats, which is what most people who are just starting now, they're all wearing all the hats. They haven't yet found a way to kind of segregate jobs, and that's the big, huge differentiator, I believe, with my team, is that I've got multiple people working on asset management at the same time, multiple people working on acquisitions at the same time, multiple people working on trying to raise money at the same time, instead of trying to be one person trying to somehow accomplish it all. I would never be able to do it. And frankly, I feel that some operators, not every operator, and I'm not going to name names, but there's definitely some that care so much about the finding deals and the raising money part, and they don't have a big enough team, that they're totally missing on the asset management part. And that's where the money is lost, is if you don't do a good job asset management. And they're like, oh, shiz, they're cussing to themselves. Oh, shiz, there's no way that we can, accomplish this. We're running out of money. And what do they decide to do? They decide that they need to get another acquisition fee of $100 or $300 grand just so that they can have enough money to put on the table. And that's just not my team.
I love that. Or they look to sell the current asset that they're failing at and lose money that way. I love that you said that. Adam, one piece of advice for the PI listeners.
One piece of advice. How about, because I know so many people talk about how essential it is to vet the sponsor. The problem is that nobody really talks about vetting a market or vetting a deal. And both of these are critical. I mean, absolutely critical. What I've noticed about the deal itself is if you look cautiously at what has the sponsor put in as the rental bumps, the rental increase, the exit cap rate, which the reversion cap just means what cap rate they believe that they'll sell it at. A lot of people see these deals and they don't know how to vet them. And they see, oh, that's awesome, you're raising rents 20% in year one, in month one. And it makes it look like a great deal, but it's just not possible. You can't do that. It cannot happen. You can't even, I don't even think you could get the rents to go up 15% in the whole first year. And people are underwriting saying that it's going to happen. And they have this logic behind why it would happen. Like they say something like, oh, it's because it's obvious that they're already 20% below because here's my 3 comps. And all we have to do is just bump it up. Well, then we need to be considering how do we know that we can raise all of the rents by 15% in the first whole year? When do people's rents end? How long are their leases? All this kind of stuff. So you really need to be vetting the deal better. You need to be vetting and looking at the deal and saying, the operator says that the reversion cap rate, the selling cap rate is supposed to be 5%. But right now the cap rate in the area is 7. And to be conservative, we need to add 2 basis points per year, which means you're actually exiting at an 8. And so if the operator can make it look so obvious that they're going to make money, but really it would never happen. It can't, it's literally impossible to happen. So you got to be vetting the deal better. And the market, there's a lot of markets out there. A lot of operators, they're taught that they need to have 8 caps. I don't think you need to be having 8 caps. You need to have good deals in good areas, even if it's a 4 cap that you're buying it at. And maybe it is, and maybe that's okay. But people are taught that they need to be looking at certain metrics in a market where you have higher cap rates and higher cash on cash. What I've noticed is in D markets, it looks like you're going to make a crazy amount of money, but you actually are losing a ton of money. And so within the markets, you've got to be looking, do I have job diversification, job growth, population growth? How big is the population right now anyway? Because there's a lot of operators that are buying in markets that have 20,000 people or even 3,000 people in a city or an MSA. and you're going to lose money. You're not going to be able to make money doing that if you're going into crappy markets like that. So you need to be thinking, do I have more than 1 million people, or at least 100,000? That's our minimum. My team's minimum is 1 million in an MSA. But like the passive investor should be taking away today is that they should never look at a deal if it's less than 100,000. That lives in that city. You should just never, ever, ever. There's no reason to. It's not going to benefit you. It's not going to help you. So you look at the MSA, look at, I think I've mentioned a little bit of job diversification. Like within the market, I've made a mistake in a city that we bought in. It was Big Spring, Texas. The deal's doing okay. I still made a mistake because I was told that you should have no one industry that takes over more than 20% of the job market. We've all heard that, but we don't always know what it means. I didn't know what it meant a few years ago when I bought this deal. And so let me share that with the listeners. More than 20% of the job force means that if more than 20% of the job force is somehow dependent on oil at all, that's more than 20%. Because I was doing something like, well, okay, so this part of the job market that's dependent on oil is a completely different job market than this part of the job market that's dependent on oil. But if it's all dependent on oil, then when oil went down, it was like $1 something recently, by the way, and at least in Denver, it was like $1 and some change. When that happened, all of the stuff in this market went down. All of the stuff got hard. A lot of people lost their jobs. There was less fracking, less oil, less jobs that were dependent on oil, and it made a difference. And it will make a difference again. So you want to be more cautious about what the 20% really means. Anyway, to sum it up, you got to do a better job, not just vetting the sponsor, but also vetting the market, making sure that it actually has fundamentals, and vetting the deal, making sure that it was actually underwritten appropriately.
Adam, how can we stay in touch with you?
Great question. Best way would probably be raisingmoneycoach.com. That is specifically if somebody wants to attract more capital and do the funnel, they can just go to raisingmoneycoach.com, schedule a call with me. If they want to be passive, they can go to realbluespruce.com and click the button that says get on the list. And they can start their journey into our funnel. So there you go.
All right, my favorite question. What is the meaning behind your company name?
Oh my gosh, that is a good question. I need to add that to one of my questions. I love it. I'm super glad that you asked this because I feel like I never get to even talk about it. It was in the beginning, this guy, Manny, and I were creating a company it ended up being called BlueSpruce, Creative Home Solutions. And we were helping people get out of foreclosure. But I wanted it to be called Manny and Adam, or Adams and Perez, or AA and MP. And I just kept thinking about all of these different names that involved that. And he kept coming up with all these. My names were probably bogus, sure. But he kept coming up with all these bogus names. And we weren't coming to an agreement on anything. And he asked me, Manny goes, well, what about BlueSpruce? And I was like, fine, yes, we'll have it be called BlueSpruce if we can make the blue and the spruce just one word. If we can put it together, hyphenate, like no hyphen, just connect it, then I'm willing to call it BlueSpruce because, whatever. But what it means to me, the word BlueSpruce, after just that long story of how we got named, is I live in Conifer, Colorado, up in the mountains, and there's all sorts of trees. There's a lot of deciduous. Those are the ones with the big leaves, and then there's the coniferous, the ones with the pine trees. And there is this one random tree that just kind of like surprises you when you're looking at all these green trees. The blue spruce is actually like turquoise. It actually looks like sky blue, and it's gorgeous. And so what we've made it mean, since the rest of the history, what we've made it mean is that we are the unique difference. We are beautiful. We are unique. We surprise you, and we stand out from the rest of the trees, the rest of the competition. We help you when we had creative real estate, when we were helping people get out of foreclosure. We help you do it a different way. When we help people with past investments, we do it a little bit different way. So that's really what it means. Sorry about the long-winded answer, but I love that question.
I love how we got there. I love it because the reason why is I always want to know the meaning behind how a company got named, and there's always the meaning. So I'm just curious by nature because of that. Thank you for sharing that, man. Appreciate you.
Thank you.
Adam, it was a joy to have you on the show, man. Really appreciate you coming on, and we hope to bring you back in the future, man. You know, you are a PI guest forever, and thank you for coming, man.
Thanks, brother. And you'll be on my show right away. I can't wait.
I can't wait, man. PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. Remember, if this episode helps you, you can help us by leaving a review on iTunes. I hope you feel compelled enough to share it with someone you think this would resonate with as well. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet, happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions, or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.